Joining me now, our own Alexander Canal and the National Economic Council Director Lael Brainard joining us as well. Director Brainard, thank you so much for joining us. So we are looking at, even though you can talk about how it was versus estimates, we are looking at inflation data that broadly is moderating, right? At the same time, when you look at how consumers are feeling, it's still very much a mixed picture. How should we think about that gap, if you will, between the data and between the sentiment out there?
Yeah, well, as you said, I think the inflation data is very encouraging. 2/3 decline in inflation down close to 3% now, and that taking place against a backdrop where unemployment has been below 4% for the longest stretch in 50 years, and growth is strong. So the overall picture, I think, is a good one. But we know that many American families still are finding many things to be unaffordable, and that's very much why President Biden is focused on lowering costs for American families. And if you look at where Americans are concerned, areas like prescription drugs, where we are working hard to bring costs down, and areas where there are hidden fees, like in banking and airlines, where we're working to get rid of junk fees. So, as you say, good progress, but we've still got work to do.
Director Brainard, another area of concern is shelter. The shelter index accounting for nearly 70% of the total increases in core inflation. Rent prices also remaining very sticky. And you said it yourself that there's an affordability issue here for Americans. How does the White House plan to address some of these problem areas in the housing market?
Yeah, so housing is one of those areas where we really need to see some improvements on affordability. We're going to be pushing very hard on that. We are seeing some reduction in rents, particularly in new rents, so that is encouraging. But we still need to see much greater supply of houses that are affordable to bring those rents down. That's why we are pushing very hard for tax credits and other incentives to make those affordable housing areas more prevalent. Zoning changes, we've got some good programs that are starting to take effect there, but we also want to make sure that first-time home buyers really have a chance to buy their first home, and so we're very focused on down payment assistance and other ways to bring costs down for those first-time home buyers.
Of course, Director Brainard, not just in your current role, but in your time at the Fed as well, one lesson is you can only control what you can control, right? So you can do some of those things at the margin, of course, to help with affordability. How optimistic are you that you're going to get some of those measures through? And if you don't, what does the trajectory for homeownership look like in the United States?
Well, I will say that market rates are already coming down. Mortgage rates have come down by nearly a full percentage point over the last few months. So that is encouraging. And in terms of house affordability and expansion of affordable housing, there's bipartisan interest in that. So I am hopeful there. We are taking funding that's available for transit. We're encouraging housing development near transit to solve both the affordability of housing challenge, but also access to good jobs. So I think there are a lot of things in the pipeline that will make a difference. And on some of these other challenges, like prescription drugs, we're already taking action. The president already secured really important legislation. Insulin prices coming down to $35 a month from $400 a month for so many Americans. Out-of-pocket costs are going to be capped at $2,000 for our seniors. And Medicare will start negotiating the first 10 drug prices. So in that area, I think the legislation is going to make a big difference.
And by and large, the economy has proven resilient. We've seen that in the jobs market. The bull case is strengthening that we could navigate a soft landing. But what are the biggest risks to the economy in your view that could derail some of that strength?
Well, I will say that supply chains, which were the biggest risk during the pandemic, are so much more resilient today because of all the investments that have been made in infrastructure under the bipartisan infrastructure law, but also the actions that have been taken in areas like shipping and trucking. So if you look at supply chain resilience, it's much better today than it was a few years ago. So that's very encouraging. Obviously, we'll keep our eyes out for risks coming from geostrategic challenges abroad, and we see a number of those. But generally speaking, because of the president's Investing in America agenda, a lot of private sector investment will continue to contribute to productivity and broader economic growth. And of course, that translates into good jobs for Americans.
Well, let's pick up on the job point a little bit, because that is one area of concern for some economists, right? That we could start to see that unemployment rate tick up more and more. I don't know if you heard the interview just before yours, but we were talking about potentially some closures within the startup industry, for example, next year. We certainly have heard anecdotally about some layoffs here going into the end of the year. So how high a concern is that for you?
Well, of course, individual companies, you'll see churn there, and that might create some challenges for employees. But if you look at the broad picture of the U.S. labor market, what you see is a picture of actual remarkable resilience. We've seen 2.8 million more Americans coming back into the labor market over the course of the last year. That is completely contrary to predictions that many people had, that Americans weren't going to come back into the labor force after the pandemic. Well, they have, and they've exceeded working age participation rates, so that's very good. If you look at the quits rate, it has now come down to the pandemic levels. All of the other indicators that I look at certainly suggest a labor market that looks pretty well balanced. Of course, we'll be tracking that very closely in months to come. But for now, on the back of that solid growth that we've seen and still resilient consumers who have stronger balance sheets, I continue to anticipate a solid job market going forward.
And sticking with that job market, wage gains, that's been a consistent headache for the Federal Reserve, but at the same time, a good thing for consumers that are battling higher prices. What's the view from the White House when it comes to really navigating that and balancing that?
Yeah, so real wages have gone up over the course of the last year. Non-supervisory workers have seen over a percentage point in wage gains adjusted for inflation, so that's very positive. That said, if you look at the overall picture on compensation growth, it's actually been moderating and is growing in line with productivity, which has strengthened a great deal. So I really see the wage picture as generally quite benign for American workers. Strong union contracts this year, of course, and not a source of inflationary pressure for the broader economy.
Lael Brainard, thank you so much for joining us with your perspective. Director of the National Economic Council, really appreciate your time, and our own Allie Canal as well.